Welcome back to DC Wealth Builders, where we don't just talk about real estate, we talk about ownership, equity, and how to turn property into power. So today we're going to dive into two buyers, same budget, same year. One buys in DC, one buys in Maryland. 10 years later, one is $250,000 more equity. They're ahead by $250,000. The question is, who made the smarter move? So we're gonna break it down today, DC versus Maryland, and which one actually builds more wealth. All right, you guys know I always give you the truth. So both DC and Maryland can build wealth, of course, but they build it differently. And if you don't understand the differences, you might make an emotional investment decision instead of a strategic one. So in this episode, we're gonna compare purchase price, appreciation and equity growth, rental income potential, taxes and potential holding cost, and the real pros and cons of each market, because they're different. And some will work for some people and some will work for others. So you just have to be clear on what makes the most sense for you. So let's get into it. The markets we're comparing on the DC side, we're gonna look at investor-friendly neighborhoods like Petworth, Brooklyn Woodridge, where I bought my very first house in Washington, DC, Deanwood, Columbia Heights, right? And on the Maryland side, think about, we're gonna actually dig into Montgomery County, because of course, Maryland's a whole state, there's lots going on, but we're gonna go right over the line in Montgomery County. We're gonna look at areas like Silver Spring, Wheaton, Tacoma Park, Kensington, right? So we're looking at neighborhoods that you might be familiar with on that side. These aren't theoretical zip codes. These are places real first-time investors and move-up buyers are actually shopping. So let's first look at purchase price. What does your money, your dollar, buy you? Let's start with the entry point in DC. If you're looking at a 2-bedroom, 3-bedroom, row home in Petworth, Brooklyn, probably $650,000 to $800,000. If you're thinking about a condo in Columbia Heights, you might be looking at $450,000 to $600,000. You might be thinking of 2 or 3 unit property that might be available in Deanwood or Anacostia, $600,000 to $800,000. If you flip over to Montgomery County, you'd be looking at a 3-bedroom, single-family home, Silver Spring, $500,000 to $700,000. Maybe looking at a townhouse in Wheaton, $400,000 to $550,000. I know I'm throwing out a lot of numbers, but just kind of anchoring you because you're gonna see that we're in this sort of similar band. Kensington, Tacoma, $600,000 to $700,000, up to $800,000. So here's the headline that you need to hear there, right? Montgomery County in those numbers is gonna give you often more house for your money. In DC, you're gonna often get location, more density, transit-oriented. So do you want square footage or do you want strategic positioning? So these aren't just theoretical zip codes. These are places, neighborhoods where real first-time investors and buyers are actually shopping. So you want to be thinking about these areas and what can get you money where. We didn't look necessarily at what those prices were in terms of a fixer-upper, one that might need a little bit of work. So thinking about each of those are going to be impacted by how much the home actually needs before you could turn in a renter or somebody could actually move in the door. So we just looked at purchase price. Now we're going to focus on appreciation. So appreciation is where equity growth is happening. And we want to look at long-term wealth because wealth is built through both appreciation, right, the increase in a property value, and the pay down of your existing loan, right? So those two things are going to impact your price and your appreciation. So in DC, we traditionally see 4 to 6% annually in the neighborhoods we looked at. There's obviously development, economic drivers that are going to create additional appreciation in certain areas. Limited supply also drives demand, right? If there's more buyers who are shopping than there are houses available, that's going to also impact both pricing and appreciation. If you look at Montgomery County, Maryland, by comparison, you might see 3 to 5% annually in some of the areas we looked at. Slower growth, but typically less volatility. What does that mean? Slower growth means your actual percentage of increase might be lower, but it's more consistent if you look historically at the appreciation in those bands over a 10-year period. In DC, you might have seen bigger appreciation percentages, but often happening in a tighter band. So strong demands are going to also drive those resale values. So let's put real numbers on one of our examples. So a $700,000 home in DC that appreciates at 5% annually becomes roughly $1.1 million. That's over $400,000 alone in appreciation. If you flip over to Montgomery County, a $600,000 home at 4% annually becomes about $880,000. That's a $250,000 difference in equity growth in the same period of time. That's not a small number, right? $250,000, think about that. What could $250,000 do in your world right now? So it becomes a strategy decision about what income needs you have and what the equity potential you're most committed to. Now let's look at rental income and cash flow. In DC, you're often going to have higher rental ceilings, especially if you're near a metro or transit. There's strong short-term rental potential, particularly in areas that have zoning that supports that. You hear a lot about this house hacking, 2 units or basement suite opportunities where you live in one and you have opportunities to rent out the other spaces. In a typical 1-bedroom condo, you might see anywhere from $2,200 to $2,800 in a lot of the neighborhoods we listed. Row homes, $3,000 to $4,500 plus. So DC is going to deliver higher cash flow potential when you make that right buy. In Montgomery County, Maryland, you're going to see lower rent ceilings with longer-term stable tenants, less transient, right? People who are going to move into a neighborhood and might stay there 3, 5, 7 years. Basement rentals and single-family homes also perform well in Silver Spring and Tacoma Park, right? You've got that demand there as well. So when we're looking at Montgomery County, Maryland on the rental side, you might see a 3-bedroom single-family home, $2,600 to $3,400 a month, right? That's the rental amount that somebody would be paying in. So Montgomery County in Maryland is going to deliver steady, predictable income, especially for family-style rentals. So the question becomes, do you want a higher upside or do you want smooth, consistent operations? That's a question you have to ask when you're looking at what kind of investment do I want to make. Next up, we're going to look at taxes, regulations, and holding cost. Big factors in this section. So where many investors, DC and Maryland, underestimate is in this category. What are those additional expenses outside of your traditional, here's my loan and mortgage, here's what somebody's paying. DC property taxes around 1.1 to 1.2%. You also have different tenant laws that are going to impact as you go up in units on what the opportunities are going to be for the tenant to come in and purchase. So you want to understand that when you're buying in, particularly in the multifamily space in DC. Rent control on older properties. Is there any sort of historical rent control in place? You've got more complex permitting and zoning. And so DC, while you might have that bigger appreciation opportunity, there's lots of regulatory things that you have to understand when becoming an investor in the DC market. In Montgomery County, Maryland, when we look at property taxes, a little bit lower, right? Roughly 0.9 to 0.1%. Now you might be thinking, that seems pretty close, but think about these percentages on $600,000, on $700,000 start to represent significant dollars when you're actually looking at the expenses, the overall expenses it takes to own and operate a rental property. So ADU conversions, you think about what's going on the tenant side, you might have a little bit less restrictions. You've got conversions that might be a little bit easier and require less zoning requirements. Larger lots, lots of grass, right, could mean potentially higher maintenance if that's something that you're going to pass off to a tenant or keep for yourself. Montgomery County, Maryland is often looked at as being more landlord friendly and a little bit easier to navigate for a first-time investor. So when you put all of that together, right, you've got a lot of different factors that we just looked at. We looked at price, we looked at appreciation, we looked at rental amounts, and we looked at what's going on in the taxes, local taxes, right, what's happening and what regulatory requirements might impact you as a landlord in an area. So the question we led with, which one builds more wealth? And here's how I would frame it. DC might be right for you if you want stronger, long-term appreciation, higher rental ceilings, development momentum that's oriented around transit, An urban lifestyle, lots of access to arts and culture and restaurants. All right, and Montgomery County might be right if you want predictable stability, a smooth landlord experience, or smoother, I should say. Smoother, because I can't promise you a smooth landlord experience in any of these locations. A little bit more home for your money, more house, more land, more space, more square footage, and a demand that might be driven by more stable long-term, right, occupants who are really ready to stay in a rental property and live there long-term. All right, spoiler alert, there is not a universal right answer. There's a right answer for your strategy, your risk tolerance, and your time horizon, your capital reserves, and ultimately your long-term vision for the real estate portfolio that you're building. So whether you choose DC or Maryland, the key is this: buy smart, plan for the long game, and do not confuse lifestyle and preferences with a wealth strategy. Remember, when you're buying an investment property, you're not most likely going to live there. So you're not picking a place that's your favorite kitchen or your ideal backyard. You want to look at the strategies and the factors that are going to make this a strong investment that aligns to your investment goals. This is the same advice whether you're buying your first property, you have a full-time job, and you're buying your first investment property, or a lot of the agents I have an opportunity to coach and consult who are building a real estate portfolio while they're also supporting and transacting business all over the DMV. If you want more breakdowns like this, real numbers, real neighborhoods, real strategies, real experiences, then subscribe to DC Wealth Builders, because wealth in the DMV is not accidental. It's intentional, it's engineered, and we're here to show you how to build it. Have a great week.